Hi everyone, welcome to Understanding Trends and Technical Analysis Part 1. So I'll just wait for about 1 more minute for more people to join us and then we'll get the session started. So for those of you guys who just joined us, a very warm welcome. So for today, we are covering the beginner trading series. So this will be on understanding trend and how we apply them in technical analysis. So along with the way as well, if you guys have any questions, do put them under the questions chat. So I have the questions chat open as well. So I'm able to see any of the questions that you guys have. Okay, let's get the session started, right? So we do have quite a lot of you guys with us today. So it's awesome. Okay, let's start, right? Just a quick introduction of myself. I'm Lee Sing. So I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalists for the best FX research for 4 consecutive years. So this session would be recorded as well so that you can take a look at them again. They will be posted on Vantage YouTube. So if you guys have any questions when you're watching the recording, feel free to reach out to me on LinkedIn. If not, if you're with us live right now, right, do put your questions under the chat box. So before we get the session started, right, just a quick disclaimer. So the information presented here, it's for educational purposes only, and they are not to be treated as investment advice. So this is the agenda that we will be covering for today. So this is a 30-minute session, right? We will be covering mainly in trends in technical analysis. So for this, we will look at the importance of trends and also how we identify them. So that would be the main bulk of the first part of this session. And then the second part, we will move on to the fractal nature of the markets. So for fractal nature of markets, essentially, we probably hear this phrase a lot in technical analysis, right? So essentially, what does it mean and how we can apply them across the different time frames. And then finally, we will move on to the 3 common methods that are used to determine the general direction of the trend. So for these methods, we are covering mainly on market structure, channels, as well as moving averages. Okay, so let's first take a look at the trends in technical analysis, right? So I'm pretty sure many of you have heard of the phrase, the trend is your friend, right? Trade in the direction of the trend. So in terms of looking at trends across the charts, the first thing that we need to determine is the time frame, right? So this time frame, it's based on 3 different things, right? So one would be your trading style. So depending on whether you're a position trader, swing trader, day trader, right? These different styles would entail different time frames. So if you're taking very short trades, for example, scalps, right? So essentially entering and holding the position across very small time frames. In this case, probably the 1 hour and 5 minutes time frame would be more relevant, right? Whereas if you are doing day trading or swing trading, looking at a 1 minute and 5 minutes time frame would not be necessary. So that's on the trading style. And then the next one that we have would be on investments objectives, right? So again, for this, right, this is also dependent on the holding period. So how long you're holding these trades. And then finally, the personal preferences. So for personal preferences, I would say that a big part of this, it's really looking more at how much time you have in terms of looking at the charts on a daily basis, right? So if you're able to commit only maybe 1 hour or so in a week, then swing trading would probably be more relevant, whereas day trading itself would not be as relevant, right? Because day trading itself would require much more commitment if you're not able to look at the charts on a daily basis. Okay, and along the way as well, if you guys have any questions, just feel free to put them under the chat box. Okay, so next we will look at the different directions of the trends, right? So essentially, we want to trade in the direction of the trend. So much as it's easy to say that, right? What we can do for a start, especially if you open up any charts, right? For a start, if you do not have or you're not familiar with technical analysis, just opening up any charts can be pretty daunting, right? In terms of looking at the direction of the trend and also identifying key levels. So in this case, what we can do, right? So later on, we will also hop onto TradingView just to explore a little bit more on that. But in general, you can first look at the market structures. So once you load any chart that you have on TradingView, essentially you can just zoom out and look at the general direction of where prices are moving. So what I mean by this is that when you look at the market structures itself in a downtrend, right? So prices would be forming your lower lows and lower highs in the downtrend. So essentially, when you trace the movements, you can see that in this case, this would be your highs and lows, right? So if you are seeing successive lows and successive highs being formed, we can conclude that on the bigger picture, prices are in a downtrend. And the assumption here is that the trend is likely to continue unless we have a change on the smaller time frame. So if you see this on the bigger picture in a downtrend, the assumption here is that we are likely to see a pullback and a continuation of the trend until there is a clear change in the market structure. Okay, so that it's for downtrends. And the same thing apply for uptrends as well, right? So it's the opposite in this case. So in an uptrend, we should be seeing successive higher lows and higher highs being formed. So something like that. You can see over here. So if I were to mark out the highs and lows, you can see that in an uptrend, usually we will see higher highs being formed and the higher lows that's being formed here as well. And if you connect trend lines across it, you can see that generally the trend lines can be connected using the troughs. So it would be the lows over here. And a downtrend itself, the trend line connected will be using the highs. So this would be the highs, right? So if I were to draw a a diagonal line across, you can see that this is generally how it will look like. In a downtrend, you're able to connect the peaks, whereas in an uptrend, you're able to connect the lows over here. So just looking at market structure itself would give you an understanding and also more clues on the direction of the trend for a start, right? So in a downtrend itself, we should see lower lows and lower highs being formed. In an uptrend, it's the opposite, right? We should be seeing higher lows and higher highs being formed. Now, in a ranging market, this is when we don't have a clear direction of the trend. So in this case itself, we can see that in a ranging market that we're seeing here, you can see that in ranging market, what happens is that usually you have support and resistance levels being formed, and these levels are being respected. So there is no clear direction in terms of the highs and lows. Rather, what we usually see in this case is that prices tend to move sideways. So in this example itself, we will be taking a look at it in deeper details in the next slide, or rather in a few slides down. So let me just clear the drawings and let's move on to the next slide. Okay, so as we've covered earlier, this is an example of an uptrend. So you can see that there are successive highs and lows being formed. The highs and lows are being marked out in the blue dots and the gray dots respectively over here. So you can see here, these are the highs and lows formed. Okay, so this is an example of how it looks like in theory in an uptrend. And if you take a look at the picture on the right, this is actually a setup that we have, right? So a setup, I believe this is on CAD Yen on TradingView. So in this example, you can see that again, there's successive highs and lows being formed, and it corresponds to the picture that we're seeing on the left over here. So again, the highs are marked out in blue and the lows are marked out in gray. So essentially, if I were to trace out the market structure of this move itself, you can see that you have higher lows and higher highs being formed. So again, the general assumption, looking at this bigger picture, it's that price should continue on the upside to form your higher lows and higher highs. And any pullback itself, right? So even if we do see a retracement, this leg itself is just a pullback for price to continue on its uptrend. So that is the general assumption, right? So the trend is likely to continue unless there is a change, or rather there's a change or break in market structure. So what we mean by this again, for change in market structure, it's essentially in an uptrend, you see that there are successive highs and lows, and generally the lows itself, they hold on, right? So they're not violated. You can see that if price were to continue, you should be forming your higher lows and higher highs. So the change in trend, or the signal for the change in trend, comes when price comes in and it breaks below the last low that we have over here. Okay, so this is a sign that the uptrend might have ended and we are seeing a change in trend. So this is for uptrend, and the same thing can be seen for a downtrend. So in a downtrend, you can see that this would be lower lows and lower highs being formed. This is what we are seeing on the left. So this is the theory part of it, right? So essentially the lows and highs are again marked out in the different colors. And if you take a look at the chart on the left, on the right, this is a chart on euro dollar. So taking a look at this, you can see that again, you can see clear lows and highs being formed. If I were to trace out the market structure, this is how it looks like. And likewise, right, the same assumption, any pullback within the leg itself, it's just for price to come into potentially a resistance area before it continues to the downside. So unless there is a change or a break above the last high, the downtrend, it's likely to continue. So this, it's on uptrends and downtrends. The next one that we want to cover would be more on ranging markets. Okay, so far, if you guys have any questions with regards to how you can better identify trends, or if you want me to go through any examples on the chart, do put it in the questions chat and we'll take a look at the requests. Okay, so the next one that we want to cover, right, having identified our uptrend, downtrend, I hope that that's clear. So next one that we want to cover would be more on ranging markets. So for ranging markets itself, you can see that markets are, or rather prices are moving sideways in this case. So you have resistance and support levels that are being respected here. So this is an example of how it looks like. So generally for resistance levels, right, you can think of them as ceilings. So these are levels here. So you have to take a look at it with respect to current price. So assuming that current prices are somewhere here, if it's trading around some on this zone itself, right, a resistance level, it's a level which price respected multiple times previously. So you can see that there is a rejection of these levels, and currently prices are holding below this region. So this level itself would then be considered a resistance level. Another way you can think of it is that this is a ceiling where if price comes into this level, it could entice some sellers to enter the market to push price lower. So essentially at this level, right, we'll see a reversal here. So that's the idea, right? So this is the concept of resistance. Of course, there are cases where price does not hold below this level and it just breaks right through. So you see that slight reaction before the push up. In this case, the resistance zone has then failed. So this is for resistance. The next one that we want to cover would be on support, right? So for support levels, you can think of them as a floor, right? So essentially when price comes into this region, you have buyers coming into the market to push price higher. So in this example itself, you can see that for support levels, generally we want to try and find areas where there are significant moves. So what I mean by this is that you can see in this chart example on the right. So let me just clear the drawings. So you can see this chart example on the right here. So in this example, you can see that for support levels that we have identified here, this would be one where we see this strong push down, right? There was this strong bearish momentum coming into this region before we saw a strong rejection of this move. So the reason why I emphasize the importance of seeing this significant swings up is because this area itself, right, this V-shaped recovery that you're seeing over here, what this tells us is that at this specific level, there are buyers entering into the market to push prices higher. What I would not identify as a support level would be something like that. So this area itself, right, this area itself would not have been ideal as a support level, right? So even though we do see this small price reactions here, you can see that in terms of the significance of the swing, this is a huge push up. Whereas for this swing itself, you can see that this is just a very minor push before it continues to the upside. Okay, so it's important to identify the support resistance levels based on the significance of the swing. If the swing is extremely small, if you're looking at something like this, before it continues on the upside, this level itself, let's see this, right? So this would have been a more relevant resistance level as compared to something like that, as compared to this area. And again, the reason for that is just based on the significance of the swing. You can see that this is very small as compared to this move here. Okay, so if we were to apply this onto the chart example that we are currently seeing right now, you can see the same thing, right? This is a significant move. And then once again over here, you can see that this itself, right, this area. So if I were to break down the movements even smaller, you can see that this itself is actually a resistance area. But if you look at the swing of this moves, you can see that this is just a small push down, whereas for this whole move itself, this is actually a strong push up, and then we saw that strong sharp rejection here. So this high itself would have been more significant as compared to, say, this high, this example here. Okay, so you can see that price once again came in, tested this region. There's this strong sharp spike up. So the wicks of the candles itself would represent the high. So how you can interpret this is that price came into this region, it pushed up into the resistance area, it swept some of the orders here, right? So people who are looking to sell, they can have their stop losses placed here. So this is what we consider a liquidity area. So essentially what this means is that just slightly above the resistance level, there are many orders that are lying above this region, right? So price came and tapped into these orders and take out the stop losses before it continued to the downside. This is also what you can consider a stop hunt. So essentially near this key support resistance levels, what you usually see over here, it's that on the support levels, right? If you have a sharp rejection of this level once, coming into this region again, it will entice buyers to come into the market to buy, right? So seeing that rejection here once. So what this happens is that when they are buying these positions, usually they will have their stop losses placed just slightly below this. So these are the stop losses, right? Represented by these 3 lines, for example. So once they have their stop losses placed slightly below this level, imagine that you have tons of orders that are just lying slightly below here. So if big players want to come into the market, right, they want to enter into a position. Essentially, they are looking for sellers to sell the positions to them. So this is why they would push price just slightly lower to tap into these orders, right? Because these are stop losses for the buy orders, which means that they are essentially sell orders. So in this case itself, you can see that when the bigger players want to come into the market, they want to tap into an area of liquidity. So an area where you have a lot of sellers that are selling at a specific price, so that if they buy with a big order, it doesn't drive prices much, much higher. So in this case, you can see that just like lying slightly below this key support resistance levels, usually this wicks itself, they represent stop hunts, right? Or tap into a liquidity area, essentially an area where you have a lot of orders lying around before price continue on the upside. So when price push down into this area, essentially what we're trying to say over here is that you have tons of sellers who are willing to sell at a specific price, right? And you have buyers coming in to fill this price before it pushes up. So this is just something to note in terms of stop hunts, right? When you're identifying your support resistance levels, especially when prices are trading in a range, you can see that at key support resistance levels, there would be a sharp spike up. Essentially, this would be the stop hunt, right? Essentially to tap into areas of liquidity before it continues to the downside. So this is an example of how it's like. So this is more on ranging markets, essentially identifying support resistance levels, and again, looking at the significance of these moves. So you can see that in general, this support resistance levels, right, coming into this region, there are significant rejections of here. And then again, the same thing here as well. Okay, so this is for ranging markets. So next, we want to cover the fractal nature of markets. So essentially what we mean by this is that markets itself across different time frames, if you take a look at the different time frames, you can see that they have the ability to act similarly over the different periods. So a reversal on the 1 hour time frame, before you see that reversal, you will notice it on the 5 minutes time frame first, for example. Okay, so shorter trends will also make up longer trends. So like the example given earlier, if we have a 1 hour, right, within the 1 hour time frame itself, so when price moves, let me just bring out the annotation. So you can see that when price moves over here, in terms of the higher lows and higher highs, within the movement itself, you can see that there are smaller candles. If you go down to the 5 minutes time frames, there are essentially smaller candles that make up this price movement. So for the smaller candles, I will put it in a different color. So you can see that in an uptrend, prices would be forming this higher lows and higher highs. And this small purple movements over here would make up the general trend, right, which is the red line that we're seeing. So this is the idea, right, of how shorter trends would make up longer trends. So essentially, any reversal would be first spotted on the shorter trends before the longer trends. So if you think about this, this makes sense because in a pullback or in this downtrend that you're seeing over here, right, for price to continue lower on the smaller time frame, you need to be seeing prices forming lower lows and lower highs, essentially to push price much lower, so that on this pullback itself, you can see this retracement. So as mentioned, right, your shorter time frame would give an early sign of change in the direction, and the same pattern is observed across the shorter and longer time frames. So for this, right, same thing, we will take a look at examples. So let's take a look at them, right? So in this case itself, you can see that just before we hop on to understand a bit more on the fractal nature of markets, right, I do want to cover on the different types of trends as well. So there are 3 different types of trend that we can consider. One would be the primary trend, the secondary trend, as well as the intraday trend. So for primary trend, essentially these are the big movements, right? They are usually the longest term trend. They can be measured in terms of months or even in years. So for this trend itself, you can see that these are the impulsive moves that we see. So if you open up any trading view charts, you can see that these are usually the huge price movements that we're seeing over here that drives the original, or rather the primary direction of the move. So if you see markets forming a higher lows and higher highs, right, your primary trend, it's bullish, as you can see. So this would be the primary trend. The secondary trend, it's usually the retracement, right? So these are the smaller ones, and usually these are the secondary trends. So they come after the primary trend. So this is an example of them. So usually this, it's measured on a smaller time frame. It can be on weeks and even months. So it will be a smaller time period. And then we also have the short-term trend, or what we term the intraday trend. So this can be measured in days or hours. So essentially, for a change in the primary trend here, we need the secondary trend to first signal the change, right? So the change in trend would be signaled first on the shorter time frames. So essentially, your intraday trend would show a change, and that would eventually be reflected on the primary trend. So if you're not too sure about what I'm trying to say here, right, so you can take a look at this picture. So essentially what we have here, it's that you can see that the primary trend, it's bearish. How so? We first take a look at the highs and lows being formed. So if we were to mark out the highs and lows, you can see over here, right, so currently prices, let me just bring out the annotation. So again, you can take a look at the highs and lows. So these are the highs and lows here. You can see that there are successive highs, right? So this high itself is actually higher than the previous one. You can see here, right? So successive lower highs being formed. Likewise, if you take a look at the lows, you can see that there are successive lower lows being formed as well. So our primary trend is bearish with this move, and the primary trend is denoted by the one in black, right? So this would be the primary trend. And then you can see that going down into this region itself, what we have here, it's the movements that are marked in blue. So let me just clear the drawings again, right? So these are the movements marked in blue. You can see that essentially for every primary trend that we have, or every black movement that we are seeing over here, this push down, what we are also seeing is that it comprises of small bearish movements that are denoted in the blue markings. So essentially, when prices are pushing lower, if you go down to the smaller time frame, right, the smaller time frames or the smaller trends would indicate this bearish move, essentially with, again, lower lows and lower highs being formed. So this is also what we mean by fractal nature of the markets. So whatever patterns that we're observing on the bigger time frame or the higher, the primary trend that you're seeing here, the one marked in black, with the lower lows and lower highs, you are seeing the same pattern being formed on the smaller time frames, which are the ones marked in blue. Okay, so like we mentioned earlier, the first change in trend, or the signal of the first change in trends, actually come from the shorter term time frames. So for this example itself, you can see that the one in blue would be the shorter time frame. So essentially, for the change in trend to happen, right, before we see this pullback, denoted by this black movement over here, what we first need to identify is that the change in trend would first come from the blue movements here. So you can see that if price were to continue on the bearish move, right, it should continue to form the lower lows and lower highs. But coming into this region itself, you can see that this is the last high that we have, and following which there is a clear change in the direction of the trend. And this is formed with the break of this high. So this is the last high over here, which causes that break. And you can see that once price breaks above this region, what this signals is that there could be a change in trend, and the change in trend on the higher time frame or on the bigger picture, this move itself would comprise of the pullback on the bigger picture, which is the markings in black. Okay, so you can see that that pullback itself, again, on the smaller time frame, we would be seeing bullish move comprising of your higher lows and higher highs, which would form the pullback before another push down. So again, right, in terms of how we identify this movement here, it's the same thing. So how we identify the change of this high itself, it's looking at, again, the structure. So you see that coming into this region, prices are forming higher lows and higher highs. So in order for it to signal a change in trend, which allows us to anticipate this huge bearish move down, given that prices are on a primary trend, right? The primary trend is bearish. In this case, the same thing, you want to identify the break of the previous low before price continue on the downside. So when prices are forming your lower lows and lower highs, this series of lower lows and lower highs would form this primary trend, right? It comprises of this leg down here. So this is the general idea of fractal nature of the markets. The idea is that you can see the reversals on the smaller time frames first before they are shown on the bigger time frames. Okay, so let's move on to the next slide. Just before that, let me clear the drawings. Okay, so now that we have covered on the fractal nature of the markets as well and the direction of different trends, right? So how do we identify an uptrend, a downtrend, and also sideways trend? What we are going to do next is to look at 3 different methods that we can use to look at this trend. So the first one is covered pretty brief, in details, right? So this would be looking at the market structure. So for market structure, again, I want to emphasize the importance of the highs and lows. So look at the highs and lows that are being formed, right? And also understand that on the higher time frames will always give us more weight as compared to the lower time frames. So what we mean by this is that if prices are forming, for example, a bearish move on the daily, so if you're on the daily time frame, right? So essentially what a daily time frame means, it's that prices are the movement in prices, right? Each candle would represent a day's move, right? In prices. So the open, high, low, close prices would be the prices that are formed within the day itself. So if the primary trend or on the daily time frame itself, it's showing you bearish market structure, understand that the daily, the direction is more bearish. So even if we do see a pullback on the 4 hours or even the 1 hour time frame, right? On the smaller time frame, you're seeing higher highs and higher lows being formed. Understand that this pullback itself, the pullback of this leg itself, it could just be the retracement of this rate movement before it comes into a resistance area to continue the bearish move down. So again, the higher time frame will hold more weight, right? So if you're looking at the daily or weekly, right? So ideally, when we do our technical analysis, we want to make sure that we are starting from either the weekly or daily time frame. The idea here is to understand that the picture on the higher time frame first, because that will help us to determine the direction of the market. So having identified that, we want to go down to the smaller time frames for the entries. So higher picture will give us more weight, right? So take a look at the daily, take a look at the weekly, identify if there are any key levels there, right? So this can be in terms of support or resistance levels that prices are currently testing. So one thing about market structure that we did not really cover in the earlier slides is that you can also use your trend lines to identify the market structure. So in this case itself, right, again, back to the lower lows and lower highs being formed, you can see that generally a trend line can be drawn across this. So let me just get the marking out, right? So essentially a trend line can be drawn here. Okay, I can't seem to find the annotation. Just clear the drawings. Okay, never mind. So in this case, you can see that this is the bearish move, right? So is usually a trend line can be drawn connecting the highs. So over here, you can see that what this is showing is that usually this trend line, right, in a downtrend, you want to connect the peaks of the move itself, right? So the significance of the swing, and this trend line would act as a resistance level. So this would be on a downtrend, trying to connect the lower peaks. On the uptrend itself, right? So when prices are forming successive higher lows and higher highs, you want to connect the lows. So the trend line will be drawn connecting the lows of each move. It does not make sense to connect the highs because in an uptrend, we are expecting prices to form higher lows and higher highs, which is why it's important that we connect the lows itself, right? So any pullback could give us a potential support level for entry. So this is in an uptrend, right? Connecting the higher troughs or the lows. So we can see that there are two ways we can use the trend line. One, it's using continuation, right? So identifying the lows to play the moves up. And the other, it's for a break of the trend line and a retest of it. So once price has held below above this trend line, you can see that prices are respecting this region as a support level. And on the break of this trend line, what this suggests here is that once price retests this region itself, there's a possible change in trend, but a clearer signal would be to look at the change in terms of the structure. So if prices are forming your higher lows and higher highs, right, if it were to continue on the uptrend, the assumption is that if we want price to continue on the uptrend, price should continue respecting these lows. So there should not be a case of price violating these lows. But in this example itself, you can see that if price breaks below the previous low that we have and that pullback, you can see that it signals this is a first sign that there could be a change in trend and the uptrend has already ended. So the break of trend line itself, they can highlight a possible change in trend. And along with that as well, we can also identify supply and demand zones, right? So in general, if there is a support area, right, or demand area that price came in respected the region previously, and when it failed, it creates a supply. So this is the same concept as support term resistance area, right? So if you have a support region which price came in to test it previously, and then once price failed below this region, you have essentially buyers who are caught with negative positions, right? So they're holding on to their losses. So once price comes into this region, there are two things that they can do, right? So one, some of them would close out their position, so it triggers sell orders. You also have sellers coming in because this would be an example of a breakout strategy, right? So for breakout strategy, essentially, it consists of identifying support resistance levels, waiting for a clear break and close below the key levels, and then a pullback and that retest to play the shorts. So we will cover that in deeper details in the next few series that we have, right, with in our Thursday session. So this is an example of how we can use trend lines and also identifying supply and demand areas, which we can help. So the second type of method that we can use to identify our trend would be looking at moving averages. So for moving averages itself, this is a popular trend indicator. So the idea is basically taking an average of a specified period, right? So for example, if you specify a 10 days moving average, essentially it takes the average of the past 10 days. So in this case, the moving average would give us or it will highlight the general direction of the trend, right? So this is actually a popular trend indicator. So in this case, how we can use the moving average to determine the direction of the trend, it's first looking at the slope of the moving average. If the moving average slopes upwards, it would be a bearish trend. Bullish trend, right? So it's an uptrend. If the moving average is sloping downwards, then it would be a bearish trend. So in this example, we can see that the moving average, which is the line, or rather the dynamic line in blue. So that is the moving average. So that's a 50 days moving average. You can see that prices are holding below the moving average. It is also sloping downwards. So what this means is that this is a bearish trend. So on top of just using the moving average, in this example itself, we also combine the market structure. So recall for market structure, we look at higher lows and we look at the highs and lows. So in this case, you can see that again, the highs are marked out in blue. So they're marked out in blue here. So these are all the highs, right? They're marked out in blue. And the gray dots are the one marking out the lows. So you can see there's successive lower lows and lower highs being formed. So you have your moving average that prices are holding below, which is the first indication of the bearish trend. And your market structure is also showing you bearish moves with successive lower lows and lower highs being formed. So these are two ways, right? You can combine not just looking at moving averages, but also looking at the market structure to determine the direction of the trend. So the next one would be on channels. So channels are very similar to trend lines. The main difference between channels and trend lines is that channels consist of two parallel lines drawn across the charts. And for it to be considered a valid channel itself, we need a tap, or rather price, to respect both the resistance and support areas. So in this example that we are seeing in the chart here, you can see that essentially this is a bearish channel that we have. This bearish channel here, again, you can see lower lows and lower highs being formed. And for a channel to be valid, we need price to respect at least the top of the channel twice, and also the bottom of the channel, which we are seeing here. So in this case, you can see that the bearish channel has been respected until this point, where we see a clear break above the channel. So this descending channel no longer holds, and price then retested the resistance of the channel as a support before it bounced higher. So this is an example of how you can also use channels to determine the trend, right? So in general, if prices are in a bearish trend, it should continue forming your lower lows and lower highs. And these lower lows and lower highs can be connected with these two parallel trend lines. Okay, so it's pretty much what we have covered for today, right? And if you guys have any questions as well, right, do put under the questions chat, right? So if you have any specific questions that you want us to cover with regards to trend lines. So we have first identified the basics of trends, right? So looking at market structure, looking at the highs and lows, and identifying whether prices are in an uptrend, a sideways trend, or a downtrend. And then we also covered the fractal natures of markets. So essentially the idea of fractal nature, it's that prices would act in similar patterns across different time frames. So this bullish moves that you are seeing on the higher time frame, you would be seeing the same patterns being formed on the smaller time frame. One thing to highlight is that the smaller time frame itself would first give us clues as to any changes in the price or the trend direction of the bigger time frame. Okay, and then finally, we covered on the three common methods, right? So on market structure, moving averages, and channels. So these are the three ways we can use to determine the direction of the trend. Okay, let's take a look at pound yen, right? So let's take a look at a trend line example on pound yen. So let me just bring up the chart on pound yen. Just give me one moment while I bring up the chart and we'll take a look at that. Okay, I have another question, right? Where can we find the recording of the session? Okay, I'll be showing you guys a recording of the session in a moment, right? Just give me one moment while I bring up the chat, right? And you're very welcome, Filippo. I'm glad you liked the session. Okay, let me just bring this up on pound yen. Okay, so I hope you guys can see this, right? So on the recording of the session, you can actually go to vantagemarkets.com, the same place that you sign up for the webinars, right? So go under education and tools, under education webinars, and just push to move down to the bottom. You can see this area, right? So just click on the previous recording here, and you can see all these recordings. So we have the live sessions, right? We have webinars on a daily basis, and on Wednesdays and Fridays are our live trading sessions, and on Thursdays they would be the educational series. Okay, so I hope that helps. Okay, let's take a look at pound yen and how we can apply examples of trend line on it. Okay, let me just move this. So again, we want to start from the higher time frame first. So you can see that on the monthly, the weekly itself, just with this whole recent move over here, you can see that it's still forming bullish market structure, higher lows and higher highs being formed over here. And again, if you have to connect the trend lines, you can see that it's still holding in a bullish trend. Oops, let me just remove the rest of the stuff, right? So this would be a bullish trend. In terms of market structure, there are higher lows and higher highs being formed. You can take a look at it in terms of line chart as well. So if you want to trace the highs and lows, you can see there are successive higher lows and higher highs being formed. Okay, so this is one example of how we can apply trend lines on pound yen. One thing I do want to highlight is that you can also check this area, right? So if prices are moving in a parallel fashion over here, right, what we can also check is if there are any channels here. So you can see on pound yen, again, for a channel to be valid, we need a tap of the support region twice. Okay, this is just bad drawing on my end, but you can see price came in, tested this region twice as both a support and resistance, this area itself, this region, and then again as a resistance here. So this is also a channel. You can see that this is basically an ascending channel or a bullish channel on pound yen. So these are examples of how you can actually apply trend line onto the charts, right? The same thing happens on the smaller picture as well. So in this example itself, you can see that this is the push up, and we're seeing that move down here, right? So if you go to the smaller time frame, you can see the same thing, right? So assuming that we have this push up, you see that big impulsive movement up, and then the retracement here, you can see that this retracement itself, right? So if we were to focus on this portion of the chart, just to understand a bit or explain a little bit more on the fractal nature of the markets, you can see that in this pullback itself, if you go to the 30 minutes time frame, essentially you can see bearish market structure here. So in order to make up this whole retracement down, you can see that prices are actually forming. Let me just remove the markings so that we're able to see clearer on the 30 minutes time frame. You see the same thing happening again here, but essentially prices are forming bearish market structure. So this is exactly what we're trying to say earlier, right? So you can see on that pull down, you can see within the smaller time frame itself, fractal nature of the markets, you have lower lows and lower highs being formed. So in order for price, okay, so if I were to mark out the highs and lows, right, tracing out the move, you can see that this is essentially how it's like. So in order for price to have a pullback here, we need to wait for price to change on the smaller time frame first. So on the 30 minutes time frame, there must be a change in trend or a break above the last high before we can see a deeper pullback. So if we are even bullish on this move itself, right, if we're expecting price to continue this move up, on the bigger picture, we need to first see the change in trend first on the 30 minutes time frame or even the smaller time frames like your 15 minutes. Okay, so I hope that helps. But just in terms of looking at trend lines and channels, you can see that if you were to apply this on pound yen, on trend lines itself, this would be the trend line, right? So essentially forming or connecting the successful lower highs that we have here. So in a downtrend, we want to connect the lower highs because the trend line itself serves as a resistance. In an uptrend, like the one that we saw earlier on the daily, we want to connect the higher lows and higher highs, this region itself. And the reason for that is because these levels or this region itself would serve as our support. Okay, so I hope that answers your question. Okay, it seems that we have no other questions for today, right? So that's all that we have for this session. So for next week, we will be covering on a continuation of what we've covered here, right? So this is the beginner series for FX trading. So do join us for that. It will be on Thursday as well, 4 p.m., right? So you can actually sign up for it and also view the past recordings on vantagemarkets.com webinars, right? You can take a look at the recordings that are posted on YouTube as well. Okay, so with that, we have come to the end of the session, right? Thanks everyone for being with us for today. And we will be having a live analysis session as well tomorrow. So do join us for that. We will be talking a bit more on using retracements and also doing live analysis and showing trade setups of the markets. So thanks everyone, right? Take care, trade safe, and we will catch you guys again tomorrow.